welcome you guys to Investor Central Academy. This is Eric here. I'm going to be your instructor for these classes as well as the live ones. But what I want to do is, we're going to cut a couple of our lessons down into smaller bite-sized pieces. And ultimately, we gotta start somewhere. And when we look at what the markets are about, how we trade options, et cetera, which is the final goal of understanding in this class, what I want to point out is that we do need to have the mathematical foundation and understand how numbers affect prices. Okay, so the way that these shorter bite-sized videos are going to work is I'm always going to explain some form of topic, right? Whether it's a mathematical one, whether it's a market one, etc. We're going to have some easy explanations, some ways to think about it, and then we're going to see how they are actually applied in the markets. Okay, so the very first thing I want to make sure that you guys understand is that different things make sense to different people, and ultimately we all have our different hobbies and favorite understandings or favorite topics that we like to talk about. So in terms of this class, I'm always going to resort to the simplest forms that I can explain something that probably applies to everybody, and then I'm always going to jump into some sort of basketball reference. That's actually something, what my favorite sport, favorite hobby, etc. So if that basketball reference doesn't quite click with you, it doesn't quite make sense in your mind, please don't hesitate. Go ahead and jump into the Discord, open up that chat with me, whether it's in your class or with me directly, and go ahead and have me, explain it to you in a manner that you would like to. So whether it's a different sport, whether it's something else in terms of animals, food, etc., I'm always happy to change and try to find another explanation that will make it make sense to you. Okay, so with that being said, this is just the office scene where Kevin is having a conversation and they give him a math problem in terms of pies and he has no problem with it. But the moment that they ask him in salads, all of a sudden he's struggling. That's just what I like to think is we all have different languages that work for us. So please don't hesitate to ask what it is that you need to understand. Now, very first, the average, it's very simple. We understand, in terms of height, the law of averages is, with everybody clustered around a certain amount of data, we generally have this middle section that we can understand will be our mean, right? The average. The average, in a nice and round bell curve like this, you can also understand there's going to be ranges that we're going to talk about, ranges of normal calculations or ranges of heights, prices, etc., that actually make sense to everybody, or that are normal, that are standard. Okay. A quick topic that is going to continue to pop up over and over in our classes, it's just a part of the language that we use, is this concept called the marble jar. Right here, what I have is, let's say this is just money. Somebody has $100, somebody else has 120. You divide by the two, you get their average of 110. But let's say there's 20 people total, and you have 10 people with 100, another 10 people with another 120. That average still comes out to 110. But here's what I want you to think about. If you add one more person, right? Let's just say somebody with 130 or somebody with just, a little bit more. When you add an additional person in here, this is only divided by 3 over here. But if I added that $130 to this equation, the bottom is now being divided by 21. Okay. So the idea here is that the averages get fractioned out more as there's more sample sizes, as there's more people, as there's more purchases, sales, etc., or in this case, people that are adding to the sample size of money here. Okay, so the larger marble jar, and when you hear marble jar, what do I want you guys to think is stability in numbers. What type of marble jar do we want? We want the larger one. We want to make sure that we have stability. These smaller marble jars have larger price swings because there's less to average out. Okay, that's kind of the thought I want you to have. What smaller marbles and smaller marble jars represent is not only a smaller time frame, or you can think of a smaller company too. Okay, a smaller company, you can imagine this could be, you know, $100,000 and $120,000. Somebody comes in with $130,000. That's quite a bit for something small. But for a bigger company, you could even imagine something like Apple. This divisor isn't going to be just 20, it's going to be thousands and hundreds of thousands and millions. And at that point, you got to understand the divisor or the stability of those larger numbers, right? The marble jar law of averages and the marble jar concept is to remember there's stability in greater numbers, okay? What else we want to think about here is in terms of the height example I have for you, you know, here it's NCAA players, but you can imagine this is going to look much different for regular people, right? Regular people are going to have a curve somewhere down here instead, because the average for, you know, for you and I think the average is like 5'6" or 5'7" or something like that. And the ranges are going to be over there. So depending on the type of data that we're looking at, right? NCAA players, you know, you wouldn't be surprised. Basketball players are going to be taller in this situation. The average here, 6'5", and we can say there's a decent range here where, you know, where would you say the majority of people stand? The majority of people stand in this chunk right here, right? You have these two little tail ends that represent small percentages of people, okay? That brings into our next concept as well, because it's always important to consider the average, but also the ones at the tail ends, right? Where you think the shortest is going to be lower here, and then the tallest is going to be up over here. It's also important to consider those, and you know, when those prices show up in a marketplace, to open your eyes to consider where it might go back to. And this is the concept of standard deviation that I want you to understand. In here, we've got men. The graph for men here shows that their average height is going to be at about 5'10", right? Oh, yeah, 5'10", male median height. And then what you have is called a standard deviation. The words I want you to think of is normal, range, okay? The standard deviation, or one standard deviation away from your mean, right? This middle red line is the mean. One standard deviation accounts for 68.1% of the total population, all right? In this situation, what that means is 5'10" up to 6'1", down to, we gotta look at here, one standard deviation is 5'7", okay? So 5'7" to 6'1", 68.1% of all men are going to lie between these two heights, all right? 68%, so that's gonna be over 2/3 of the population. Then when you go another standard deviation out, right, another range of normals, what you end up opening up here is you actually add in another 13.6. The total percentage for two standard deviations is 95% of people. So 95% of people are going to be between 5'4" and 6'4" for men, okay? And what that simply shows us is two standard deviations is 95% of people, okay? Standard deviation is important for us to understand, because when prices go toward the tail ends of our of our averages, right? When when they're far away from the mean and their standard deviations away from the mean, what that starts to give us the feeling of is that they're going to head back toward their averages. On the bottom here, what I want to just quickly reiterate that concept of, Stephen Curry's averages in this situation. He scored 20.8 points in 2019, 2020, but he only played 5 games. So for every additional game, those points end up influencing and dragging this up and down more significantly. They're going to have faster movements. If he scores 40, that 40 is going to be divided by 6 instead of, in this situation, if he scored 40, even here with 17.5 points, 80 games, that 40 being divided by 81 is going to add a lot smaller of a price or a point difference for him. As a result, what you can think of here is that there's more stability in his average here for 80 games. That 17.5 is more stable than this 5-game 20.8 points. Okay. And that's just the marble jar and stability in numbers. We're going to get into the chart really quickly. So one of the things that happens in the marketplace is, we have these charts that are going to plot out the price. With that price, what we can do is we can plot out an average. Now, the average is always going to look in hindsight, right? So if I'm looking at, in particular, this specific time, right, this price right here, they're going to take X amount of days in the past to calculate to find that price, that blue line, okay? And, if price shoots up here, et cetera, this day's calculation, okay, let's go there. This day's calculation on this blue line is the result of previous days, right? In every moving average, you can look and say, I want the last 5 days, I want the last 10 days, right? I want the last 5 days, I want the last 10 days, I want the last 50 days. You can choose how many days you want to use to calculate that average, and each one is going to have a different type of significance, right? So the moving average is a very widely used indicator that not only helps you smooth out the price action, because you can see these prices fluctuate quite greatly, but it will be a moving average that smooths out what everybody does together at the markets. It kind of does filter out the noise of the random short-term price fluctuations, and it's a trend following or lagging indicator because it uses, like I said, past prices, okay? It's always going to look at what has happened in the past, and you cannot form the next movement or the next direction of the blue line until you have the next day or the next hour or next minute of candle prices that close out. What we've been talking about so far is the simple moving average, SMA, which is just, again, that average, basic average, divide by 20, divide by 30, divide by 50, divide by 100, or divide by 200. In terms of the dailies, these are some significant ones to consider. We'll show you that in a moment too in our charts. On the other hand, there is also this thing that you may see called the EMA, the exponential moving average. And what that does is it gives higher percentage weights to more current prices, okay? So for example, if each price here, each used to get 1 unit, the one closest to, or the newest price may get more than 1 unit of multiple or more weighting, right? Gives a greater weight to more recent prices. And this does help consider what more current trends happen to be, because what it is it's considering today and right now's prices a little more than, let's say, 20 days ago, 50 days ago. Those numbers get considered, but a whole lot less than what would happen in an SMA. Then there's this one called the moving average convergence divergence, so MACD, MACD. What this is it's comparing a 12-day average to a 26-day average. What that can be considered is it's considering the short term to a longer term. And if the short term happens to be much more green, right, you have positive values that result from this. that ultimately means that you're on a hot streak, okay? But if you happen to be doing poorly in the last 12 days, right? Prices are lower than what the last 26 days have been averaged out to, then that's a cold streak. It's a downward motion, downward average calculation. We're going to jump right into our charts, but again, I'm just going to reiterate, a whole part of our class is to make sure that if you have the questions, go ahead and ask them, go into the Discord, go into your chat, and go ahead and ask away if there's certain things so far that don't make sense. All right. Okay. Let's jump into our charts. Okay. What I've got here for you is Trading View. You also do have a Trading View introduction video. Also, you do have a Thinkorswim introduction video. Either way, what you're asked to do here is to have some form of a chart that you can actually consider. What I've pulled up here for us is the SPX Standard & Poor 500. It's the index that gives us the top 500 companies and what's going on in the broader market in terms of price and price movement. Now, we're not going too deeply into these other lines that are showing up. The main ones we're going to talk about today are simply going to be our moving averages. If you go under indicators and you type in BB 510, you'll see this BB with 5, 10, 50, 100, 20, SMA daily, etc. Go ahead, click that. I've already got it shown over here. And what we want to do is double check in here. What I've already done for us is I've put it in terms of the order of the colors of the rainbow: Roy G. Biv, red, orange, yellow, green, blue. And I've done 5-day moving average, 10-day moving average, 50-day moving average, 100-day moving average, and 200-day moving average. Now, the two that we're going to focus on right now are 50 and 200. Okay. The reason being is that when they interact with each other, when the 50 is above the 200, that's a good sign, right? Because the shorter term ones pull the longer term ones along with it. But when the 50-day is below the 200-day, that's a bad sign. That's not very good, because therefore the 50 is going to drag the 200 down with it. What I mean by drag, let's go ahead. Before I take off the other ones, what I want to show you here is the one that's the closest to the prices in here is going to be the red one, okay? The 5-day moving average. It's only considering the last 5 days, and it's going to be very closely tied to the prices. Orange, you can see, starts to separate itself a little bit further. It's considering more prices from the past, and therefore considering, not just 5, but 10 days, right? That's what my indicator in here has been set to, 10 days. Keep in mind too, I'm up here on the daily, and these are considering day candles. The yellow is 50, green is 100, and blue is 200. And just in terms of a very basic understanding of this, is that the longer term averages will act as support in many instances. What does that mean? Is that when prices come back down to that 200-day moving average, there are formulas or algorithms that are designed to go ahead and pick up those shares as soon as they can. And so overall, this has been kind of a long-term strategy, a very simple type of strategy in many cases. But you got to keep in mind too, it's not going to necessarily always time things perfectly. For example, here, when it dropped back through, it came back down, but then eventually came back up and went back higher. Same here, when it broke down below the blue, there are times where people do consider, in terms of the market and the way it moves, buying at the 200-day moving average is not a bad idea, right? But it rarely comes down to it, and you have to be ready for those situations. And at the end of the day, it is not foolproof. You have situations where it does give you quite some pain for quite some time as a result. So, it's just every every little bit that we teach you, we like to think is another piece to the puzzle and adds probability. There are many instances in which these longer term moving averages will support the market and prop them back up. And there's, you'll hear things like, oh, the 50-day is what is going to be respected when we are going up, right? But then the 200-day is what gets respected on the way down, right? Whether or not you see those or actually understand how that happens, what I do believe is the marketplace, like the marble jar, is everybody put together doing, different strategies that all come together to eventually numerically support the market in those situations. So there are other situations where these prices down here, maybe somebody isn't using a 200-day moving average, but it is still showing that it is a heavily discounted stock and they should purchase. And there are people piled in, and that's what pushes these prices away from these lows. Now, what else we want to talk about in terms of moving average? We also have, real quick, when that 50 and 200 cross, I'm just going to take it off so it's just yellow and blue. When they cross each other, there's what's called a golden cross. So golden cross, let's put it here. When they cross yellow above, that's a sign that we're entering a bull market in this situation. So there is a little hint here that that's what people are expecting. On the other hand, what you have is called a death cross, and that's when the yellow crosses down below the blue. And that usually signifies that, there's a cold streak or a bear market and downward movement coming from that. Now, I want to point out, it's not always going to time things perfectly. Like this big movement in 2020, things move very quickly. This indicator would have actually timed exactly the bottom when you think about it. So again, these are just, averages. Averages are sometimes going to be a little bit slow because they're always looking backward, right? Retrospectively, and looking for these previous prices, and it's not going to calculate that and make that drop until these prices have shown up. Okay, so moving averages are something for us to consider. They're not the holy grail, but they are important to understand that there is a broader picture, big picture, big marble jar type of action that does happen when it comes down to these averages. In addition, let's talk about here where we have what's considered the Bollinger Bands. And what I want you to understand here is earlier we were talking about how, really quick, we've got our standard deviation 1, 2, and 3, okay? 1, 2, and 3. What this signifies is that, remember I said 68% lie within one standard deviation, 95% lie within 2, 99% is within 3, okay? Quick thought in that as well is to say, well, if Steph Curry's average is 25 points a game and his standard deviation is 5, just to make it round. So any time that he scores 20 to 30, that's 68% of his games. However, when you go another 5 points out, so 15 to 35, that's going to be 95% of his games. That's the majority of his career. And if you go to 10 and to 40, what that is going to be 99% of his career. Okay, 99% of everything lies within 3 standard deviations. Now, what does that mean in the marketplace is we have this really interesting, this interesting charting moving average with this little cloud that exists around it. Well, that's just your moving average with a standard deviation. And right here, what I've done with my numbers, if you can see here, is 2.5, meaning that not 2 standard deviations, not 3 standard deviations, but halfway in between. So you can understand that 98% of prices are going to be inside these values. Do you see that here? Yeah, because like here, you have a few times where it maybe peaked out outside of it for a moment. But what does that mean in terms of prices? It means that it was on the tail end. It means that Steph Curry just scored 10 points or just scored 40. Now, if you were a betting man, if he scored 10, do you want to bet he's going to score more or less after? More, right? Because if 10 is on the low end, right? If 10 is down here, 99% of his games are higher than that. You're going to bet that the chances are he's going to score higher than 10 points the next game. But if he scores 40, right, then you would want to say that it's going to go in the other direction, head down. So this is saying he scored too low. This blue line being below the blue line shows that these are extremely, extremely far out of the ranges that are expected. Okay. So anytime that price has hit the lower end of the Bollinger Band, especially what you'll notice is it tends to happen in quick motions, quick movements. What tends to happen, would you say? Prices eventually revert. Do you see that? Revert. They'll bounce away from it. Okay. Simply meaning that the marketplace is seeing that as a undervalued price when it hits the bottom here. And on the situation where, let me find some on the left, when we're headed up, you can see the top end of it shows, hey guys, we're a bit too overvalued, and it rejects away, okay? Now keep in mind, just knowing this isn't going to be enough to necessarily profit. There's still other things we gotta go over, but for today, our first quick little video here, you have Bollinger Bands, you have your moving averages. You know, now if you see something like this, you know, it still kind of hurts my head, but ultimately you have an idea of what these things do mean. If you're using TradingView, go ahead and go in here. You know, I can mess around with this. I can make the Bollinger Bands different sizes. I can go down, oh, it was this one. I can go down and I can make this a 1 if I wanted to, right? And it's going to shrink these ranges for me. Therefore, you know, everybody's got a little bit of a different approach when it comes to some of these numbers, but the standard here, you can say standard that's given you here is actually a standard deviation of 3, because keep in mind 99% exists within that. Chemo, and I would say you can go and change it to 2.5. There's nothing wrong with that. 2.5 is still 98% of everything and gives a little bit of that buffer room to, you know, to look for. In your charts, if at any point you feel that you see something you want to share with us, you have this ability to copy your chart image and go ahead and control paste, command paste it directly into the chat that we have. That way we can give you additional pointers or additional things that we see if you want to converse about these averages that we're talking about today. All right. That was today's quick little video on averages and standard deviation. And so now you have a way to picture those when it comes down to the charts. I'll see you guys in the next one. This is Eric signing off.